So, are we having fun yet? Hey, it's Victor Medina. Listen, I can't believe that I'm actually recording a second video in about 2 weeks, really with an opportunity to talk to you about market volatility and what's going on. I'm recording this Monday, April 7th, about 11 o'clock in the morning, and the market's going haywire, largely due to the uncertainty that's coming around the recently announced tariffs and the market's reaction to that. Now, first thing I wanted to talk to you about was that this kind of market volatility is actually an indication that the market is working correctly. I know it sounds like markets should never go down and you should never have volatility that's as great as what we're experiencing in the last few days, but it's actually the opposite. See, if investor concern did not drive market volatility, if markets didn't react in a way negatively around uncertainty, then actually we would learn that the markets don't run efficiently and it's not a well-designed market. But the fact that we're seeing this kind of volatility is actually an indication that the markets are working exactly as expected. Now, none of that feels good, because if you're looking at balances on an account, you're looking at the loss of value, and that often asks you to have an emotional response to that. And we've got a lot tied up in how much money we have, because there's so much certainty and security wrapped up into the balances that are in those accounts. But if you don't have your money that you need today in the market, then this kind of activity should really not be that big of a concern to you. And actually, for the majority of our clients, they have money that is not in the market specifically for this reason. They're not relying on money in the market as their today money. Or they've got a circumstance in which they have enough money invested for a long enough time that as we start to generate income, we're actually taking gains from 10 years ago and using those to live off of. The performance that we expect from the markets today is really going to be used for money that we're going to generate 7 to 10 years down the road. So the biggest impact of what's going on has to do largely with how close to your day-to-day living is the money that's invested in the market. And if it's really close, you have every reason to be concerned. But if it's not that close, if you know that your today money is not there, then you probably shouldn't have much concern at all. Now, come with me. I want to show you a little something. This is actually the volatility index. This is the VIX, and it tracks how volatile the market actually is. Now, one of the things you'll notice here, this is a look at this index all time, going back to pre-1990 or so, and you'll see that these peaks have happened over the period of time. If you look, and I'll bring my cursor over this here, if you look right here, this is going to be 2008. This is going to be the market collapse of 2008. You saw that that number is super, super high up here at a high of almost 90. And then we kind of move along. We've got another one in 2011. And we have this other one here in 2020. Anything happen in March of 2020 that we remember? Of course, that was COVID. And all of the news is announcing that this is the biggest volatility, the biggest drop since COVID. You know, there's something really instructive in that statement, because it turns out that if this is the biggest drop since COVID, that means two things. One, COVID had more volatility and this is less. And the question is, did we get through COVID? We didn't think so at the time. The world was ending. Global trade routes were ending. No one could leave their house. Nobody was doing any manufacturing. And so in terms of the right to be concerned, or the level of worry that people had, probably a little bit bigger in COVID, and yet we got through it. And so one of the lessons that we can take from this is that, as bad as things seem, there is every hope and expectation that the future will actually bring positive returns. Let me go back to that volatility index for you real quick. The other thing I want you to notice is how wide are these peaks, meaning how long did things stay volatile for? And it turns out that these markets over here for this volatility did not stay this way for very long. These peaks were large but limited in duration. And so if we look at the actual peaks themselves, you'll see that they didn't last a very long time. And so one of the things that I wanted to do in this video was share with you some perspective that volatility, as uncomfortable as it is in the moment, doesn't last very long at all. In fact, in most cases, 10% of it is gone in 2 or 3 days, 30% of it is gone over 3 months. And so we understand that these bouts of uncertainty, this tumultuous ride that we're on, is something that, while is uncomfortable, isn't going to last for a very long time. So I'm hoping that this video gets you some perspective and puts your mind a little bit at ease about what's going on. I know that my today money is not in the market. I'm participating in the market largely because I expect positive returns over the long term, but my today money is not wrapped up over in there, and neither are any of the clients that we're working with. So if you're watching this, but you're not one of our clients and you're not working with an advisor that's actually thought about this and done some planning, maybe it's time to give us a call and see if our plan might not work out better for you. Hope this helps give you some perspective to this April day. Here I am in New Jersey. It's kind of rainy and dreary. It's probably totally appropriate for what's going on for the subject of this video, but there are going to be brighter days in the future. Of that, I'm confident. So I'm going to keep my shorts and t-shirts out, and I'm going to be looking for that better weather because I know it's coming around the corner. Hope you have a great day. Bye.